Are we finally out of the woods? This market spent the last 2 months steadily chugging its way higher. After yesterday's phenomenal rally, stocks are now trading like a new normal might be within reach, or at least they were until 3 o'clock today. But we need to be careful. This is still a very uncertain moment. We don't know if we'll be able to safely reopen the economy without causing a second wave of COVID infections. We don't know when we'll get a vaccine. We don't know how quickly the economy can recover. At times like this, I like to take my emotions out of the equation and go with a more quantitative approach. I hope things get better. I obviously thought that we could be heading into a severe depression. I fear that they might not get better as fast as many think. We need to put all that to the side, though. And that's why tonight we're going off the charts with the help of Carolyn Boroden. She's that brilliant technician who runs the FibonacciQueen.com website and also happens to be my colleague at RealMoney.com. And by the way, Carl Quintini and I both go back and forth on Fibonacci and how important it is lately. The thing you need to know about Boroden is that she nailed the crash. When we checked in with her in early February, she warned that the market was vulnerable to a major downside correction. When we spoke to her again in early March, she cautioned that the averages probably hadn't bottomed yet. If you took her advice seriously, you could have sidestepped one of the worst declines in history. So how does she feel about the current setup? All right, take a look at this daily chart of the S&P 500. Boroden thinks this is a binary picture. If the big index can break out a bit higher from these levels, she predicts a monster rally. But if it can't mount a breakout, then she's a little less sanguine. First, though, let's jump back to late March because it's a great illustration of how our methodology works. All right, so remember, Boroden's called the Fibonacci Queen for a reason. She measures past swings, then runs them through the prism of Fibonacci ratios to get a potential price target and timing targets. When she finds a cluster of these important Fibonacci levels, it's often a sign that a stock or index is ready to change direction, so it's a predictor. When the S&P bottomed in March, you had a cluster of Fibonacci price relationships running from 2,165 to 2,194, and we only bottomed at 2,191. Meanwhile, based on the duration of past swings, there were a bunch of Fibonacci timing cycles running from March 22nd to March 26th. We bottomed on March 23rd. This is all the stuff that was available in her work. Since then, this chart has turned much more positive. We've gotten a series of higher highs and higher lows. We've got a breakout over the 5-day exponential moving average. The 5-day is the blue, okay? Right there's the breakout above it. On the 30-minute chart, where every tick represents half an hour of trading, Boroden's gotten her favorite buy trigger, the ultra short-term 5-period exponential moving average crossed above the 13-period moving average, and there we go. That's what she really wants to see. I know, a little technical. There's just one fly in the ointment. The S&P still hasn't broken out above its 200-day simple moving average, which is currently around 3,000. That's what makes this chart so binary. Boroden is concerned that the 200-day moving average could act as a ceiling of resistance, and it might be a hurdle that can't be taken out, and it has to be. Don't get me wrong, she thinks the S&P is a buy right here. There's too much going right in her charts for her to say anything else. However, she says you should be ready to sell if we fail to break out over the 200-day moving average eventually. Once we get above that level, though, Boroden's got some incredibly bullish longer-term price targets, 3,720, maybe 4,136. Oh, that'd be huge. But if the S&P can't clear that hurdle, if instead it breaks down below the May 14th low at 2766, well, guess what? All bets are off. All right, so how about the more tech-heavy Nasdaq 100? Hey, here we go, much cleaner picture. And it should be. Remember, I told you the S&P 500 is not working as an index. This is the one to follow, or the Cramer COVID index more specifically. Boroden points out that the Nasdaq 100 is above both its 50-day simple moving average and its 200-day moving average. Well above. It's already cleared the hurdle that she's keeping an eye on the S&P. Her buy trigger on the 30-minute chart has fired. Best of all, she's noticed a pattern in the Nasdaq 100. Ever since the bottom, all the momentary declines in this thing have been pretty similar in both time and price. They last for 1 or 2 days, and then the index bounces back. Could be a good day tomorrow. At the moment, Boroden thinks the Nasdaq 100 is pointed higher. As long as the price holds above last week's lows at 8860, which is down 5% from here, this chart remains bullish. Her next upside target, she could see the index headed for 9,489 and then 9,660. That's some higher potential targets come into play. You know, I don't want to mention 11,569. It'd be too outrageous, but it would be a new high. Anyway, what would make her less bullish? Again, if we get a decline below last week's lows, I mean, that just ruins the story. And she'll be watching the 30-minute chart for that 5 to 13 period exponential moving average crossover in the wrong direction. But until then, she expects the Nasdaq 100 to keep heading higher. This is where you should be, people. What about the Dow? All right, take a gander at the daily chart of the Dow Jones Industrial Average. From Boroden's perspective, chart's good, not great. Not only does the Dow have a substantial amount of overhead resistance, it's also below the 200-day simple moving average. Pretty pathetic. While it's still bullish, the Dow has a hurdle to jump, just like the S&P 500, but it's a more difficult hurdle, which makes sense because of its paucity of digital and biotech, and those are the two strongest areas. Think Nasdaq 100, think Cramer COVID Index. Boroden says you have to be prepared for a breakdown if this thing can't burst through these ceilings of resistance. For now, it's working, but stay vigilant, because this picture could get real ugly if it stops working. Finally, let's go to the Russell 2000, the small cap index. Again, it's a very similar setup. Russell's currently in the low 1300s, and it's got a bunch of resistance from 1399 to 1445. There's resistance still below the 200-day moving average, which creates another ceiling. If the Russell can jump these hurdles, she could see it running to 1576 or even to 1953. Longer term, though. But if that upside breakout fails and the Russell sinks below 1200, back in the hot water again. Here's the bottom line. The charts, as interpreted by Carolyn Boroden, suggest that the major averages are still in rally mode. But it's a precarious rally where you need to proceed with caution if we fail to break out from these levels and slip back to where we were not that long ago. Let's go to Lloyd in Florida. Lloyd.
Hey, Jim. How you doing?
Lloyd, pretty good day. How about you?
Doing good so far.
So let's go to work.
No problem. I had a question in regards to Aurora Cannabis stock. It fell to $6 and increased all the way to $19 today. I was wondering, is it still a good buy for that stock right now?
This is a controversial story, and I'll tell you why. This has been a major short squeeze. But when I comment on these things that it's a short squeeze, what happens is people get very angry at me. Okay, they say, well, wait a second. I mean, give me a break. It's not a short squeeze. And then if I say, because it's short squeeze, that's why it went up so much, they get even more angry. They say, no, it went up because it's really doing great. So my case is that this one money's been made, and I really don't care what people say. And we know why that is. Because I have become, after multiple years, Jimmy Chill. Let's go to, hey, it can be Davey Day Trader, although I come with that much better credentials. Let's go to Ryan in Virginia. Ryan.
Hi, booyah, Jim. I want to get your take on Altria and Philip Morris. Altria yields over 9%, and Philip Morris yields close to 7%. Given that interest rates are low and many tech valuations are stretched, what do you think about these two stocks?
Okay, I made a decision in consultation with my daughters not that long ago, a couple years ago, that I would not recommend these stocks because they feel that it's my job to be able to tell people not to smoke and that it's bad for you. So my answer is they'll have to go to someone else. I want to be nice about it. I'm not trying to be mean, but I made a promise to them, so I don't care for these two stocks. Anyway, the chart suggests we're in rally mode, but one where we proceed with caution. Although I have to tell you that Nasdaq 100, did that look good or what? All right, much more Mad Money ahead. 1 in 4 Americans works remotely, and more hackers, of course, are targeting home networks, because it's even more fun for them. Identity security has become even more critical. I'm eyeing one, I know there's several, but a new one that can help. Then, when a call center becomes the first touch point for a customer, how can you ensure business can continue to run smoothly remotely? I'm calling them contact centers, and I'm talking with the CEO of Five9. That's 99999, not the 9 to 5. And all your calls rapid fire in tonight's edition of the Lightning Round. So stay with Cramer.
Don't miss a second of Mad Money. Follow @Jim Cramer on Twitter. Have a question? Tweet Cramer. #MadTweets. Send Jim an email to madmoney@cnbc.com or give us a call at 1-800-743-CNBC. Miss something? Head to madmoney.cnbc.com.